Who's killing us? Who's writing our obituary? It's the venture capitalists.
That's Michael Walrath, CEO at Yext, and he's in an absurd position. On one hand, his business pumps out cash, over $100 million in EBITDA, but the markets have decided SaaS companies like his are near worthless compared to AI native disruptors.
You're at close to $500 million in revenue and wildly profitable, and you're worth 1 times revenue. That startup I just funded that's going to kill you, that's worth 100 times revenue.
In today's episode, Michael shares how SaaS companies can not merely survive in this environment, but win if they embrace the compounder mentality.
If you compound effectively, you will out-return these super high growth stories in less.
Our discussion also explores how the so-called AI layoffs have very little to do with AI, plus how to keep your team focused when everyone outside is telling them your company's already finished. If you're a senior revenue operator in tech, this one's for you. Welcome to Topline.
Welcome, listeners, to another episode of Topline. Yes, it's me, AJ Bruno, co-host of Topline, also CEO of QuotaPath, here with Asad Zaman, CEO of Sales Talent Agency, and Michael Walrath, the CEO of Yext. Actually, we've had Michael on before, so I don't even need to give Michael an introduction. He's got a crazy world going on, and we're gonna jump right into it. Asad, Michael, welcome to the show. How you guys doing this morning?
Awesome. Thanks for having me, guys.
I'm excited to have Mike back. This is going to be really fun. Mike, you've had an entertaining and interesting couple of quarters, and so we're going to talk about all of this. Let me give a bit of a frame, and then
set the stage on this, Asad, because there's a stage to be set for sure.
Whoever's listening knows Mike has been around in tech for a while, has built Right Media, was early on at DoubleClick, then built Right Media, sold it to Yahoo, is now the CEO of Yext. Yext was founded by another individual as well, Howard, who is now the founder of Rome. We are happy Rome customers. And so Mike,
but just so everyone knows, Mike, you've been the CEO of Yext for 17 years, is that right?
No, I was chairman for 12 years, and I've been CEO for 4.
Okay, so you've been a part of Yext for 17 years, though, which is
that's right,
a lifetime in software world. For
it's been a journey.
So Yext is now publicly traded. It's what we call a mid-cap public company. 400 million in revenue. You've got about 100 million in profit. You spend about 140-ish million on R&D. And you are a SaaS era company that, like every company, has challenges it's working through. For you, it's growth and maybe churn in a particular segment, not across the business, but in the SMB side, maybe it's things you would think about solving for. And then, like all of us operators, you're thinking about how to rediscover the business in the age of AI, right? And so for AJ and I as operators, when we look at your position, we look at it with a bit of envy. We're like, look at Mike. Mike has all these resources.
Does this make you feel better, by the way, Mike? Right before your earnings call you're gonna have later today.
So far, this is nice, and this is the nicest interaction I've had in 11 months.
So for us, it's like, okay, look at Mike. Mike's sitting there. He has all these customers. He has a great team. He has all these resources that he can invest towards rediscovering this business's next phase. But then you are a public company that sits in the public markets. You have analysts and commentators who've basically proclaimed SaaS is dead. It has little ups and downs here and there, but like broadly speaking, SaaS is dead. It's all about AI, and it's all about AI that is brought to us by companies born post ChatGPT's launch and market. And so that's affected you. You guys are trading at 1 times revenue. The stock is suffering. Just reflections on the last couple of quarters at a high level. But then the real operating lens question for us is, how do you have a plan of what you want to execute against? How do you stay course, and how do you keep employees on course when you've got all of this external negative momentum and noise causing distractions in all of this? How do you maintain course?
I think there is a lot to envy about our position, right? The company is worth roughly a third of what it was worth at the IPO 7 years ago. That's a weird place to be. I think we went public with a little less than 200 million of revenue. And I think the company at the peak was worth, 2.8 billion, 12, 13, 14 times revenue, something like that. we sit here today and, we'll around 440, 450 million of revenue and ARR, well over $100 million of EBITDA. We don't give guidance anymore, so I can't really talk about guidance numbers, but all those metrics have been improving. And the market hates it, right? And, what I hear, especially if I've recently rejoined X because I feel like you got to have some way to participate in the dialogue, but it's like being Bruce Willis in The Sixth Sense, right? Like you're dead, but you just know it. Who's killing us, right? I mean, who's writing our obituary? It's the venture capitalists who are funding high growth ARR companies, right? Like no one knows what this ARR means, right? There's no net retention data. There's no gross retention data. There's no data. And they're, well, that new one's worth 3 times what Yext is worth, right? Why do you think all these companies are going to beat us? And they say, well, because they can move faster, because they're AI first, because they don't have the legacy stuff, right? And I laugh about it because, you mentioned it. Between sales and marketing and R&D, we can spend 140, 150 million dollars a year and still pump out $100 million of profit, right? That profit is leverageable. I can borrow money and buy things. That profit is usable. I can pour it into R&D and sales and marketing on things that are working. And, I have customers, right? I don't have customers who signed up for a pilot that I annualized in ARR, right? Like we've got these customers who have been
for ages.
Fortune 500, Fortune 100 companies have been a customer for 12 years, right? And this is the part that I think the market just has trouble with, is this isn't as simple as these guys are going to win and these guys are going to lose, right? Like these cycles don't work that way, in much the same way that in 1999, Amazon was, the internet was going to kill everything. Walmart, it was going to kill Walmart. It was going to kill Target. It was going to kill Kmart. It was going to kill Sears, right? And it turns out
it did kill Kmart, for the record. Kmart
right,
definitely did die.
Yeah, that's the point, right? Is it like, but Walmart since 1999 has 8x, it's worth $1 trillion, right? It's 8x its business since the internet came to kill.
Yeah, it's far more nuanced and textured than what what's interesting in all of this is that if you look at analysts and commentators, they want to say the most alarming thing because that's the thing that gets the most noticed, right? And I think when you are trying to become known or you care about brand, and something we have to be really careful of is that it can sometimes push you to take almost these binary positions. And so one binary position of the last couple of quarters was that anyone who hadn't rediscovered growth from the SaaS era by, let's say, the start of this year, it's too late. They're never going to do it. They're too slow. They're not going to be able to. They have too much tech debt. They won't be. And then what kind of happens is in the last few days, we've seen doesn't really matter. As soon as you show the growth, the market's like, I'll get you. Like you were the one that was going to do it. Like Snowflake and Mongo and all of these companies. I've been in Mongo's stock for a while and it's like, it's a wild ride. Like there was a quarter where it was up 20, then down 20, then up again. And so it's, how do you know all of this? You know that the minute you guys come back with real growth numbers that are exciting, that show that, there's an AI story here, that your pie starts from a pop and your valuation will be back where it needs to be. How do you keep the team and customers and prospects, how do you let the noise not affect them in a way that actually ends up holding you back from being able to achieve that outcome?
Yeah. Well, I mean, there's so many narrative violations that I'm going to commit today.
We're a narrative-free podcast, so that's totally okay. You can do whatever you want on here, Mike.
My team, I got to show you guys this. My team handed this to me before 5 minutes before I walked into the room today. This is the new t-shirt. So we have, you'll see me, I'd say 90% of the time I'm wearing a black t-shirt with the Yext logo in the circle. And so
if you're listening to this on Spotify, you got a DGAF t-shirt, just the emblem right in the middle of it. It's the best. You need to see it on YouTube.
If you select for individuals who really buy into the hype, if we're not vibe coding this key critical infrastructure, data infrastructure layer for all of our customers by the end of next week, then we're dead. It's just picture Jason Lemkin's voice, right? Like if you haven't replaced, 1,100 employees with agents in the next 2 weeks, then you lose your founder card. You were never a founder to begin with. I find it comical, right?
super
it's
binary, right? Like
yeah,
super binary. He did say that like at the start of this year, if you haven't figured it out now, like it's too late type of
yeah.
thing.
If you sell like, a lightweight SMB software solution, like that may be true, right? Like that may actually be right. If you're not there and, owner.com is going to come eat your lunch, or one of these other like, AI native cursor shops that are just, it's awesome what they're doing, right? But that's not how big enterprise works. And so like we just put out our earnings today, so the data's it's sort of up to date. Like we're 91% of our revenue comes from accounts that spend more than 50K with us, which is how we define enterprise, right? And the top end of that book is 10 is 8, it's almost as much as AJ spends with
Intercom
Intercom.
with
It's like
Finn. They renamed Finn
with Finn,
actually.
Finn. Yeah, exactly.
Yeah, it's so funny you mentioned that because I literally just got an Finn because we upgraded further, and I got an invoice in my inbox this morning, and I almost just wanted to write directly back. Like, there's a few zeros missing in this invoice right now.
Now to pay
But
for Finn.
Mike, your point around this, because I think where this is headed, which it totally makes sense, is there's competitors out there that are raising a ton of money, and VCs are looking at these businesses and their growth rates. I guess, like, how should the market really be scoring these? Should it be by traditional metrics, or is there, some other blend of something that, like, makes more sense in today's world? Or is that part of the problem where we just don't know, we don't know, and so you have this wild volatility?
I think this wild volatility needs to be understood in terms of like what's driving it. Venture guys, right? In this case, I think the loudest voice in this market are your sort of venture investor and your venture backed founders. Those are two different sides, right? So your venture investors, and I have lots of friends, and this may piss them off. Like they're remarkably sure of themselves for guys whose whole business model is being right 5 to 10% of the time. That's the business model. If you're right more than 10% of the time, then like you're probably being too conservative as a
But
venture
are they
investor.
right in do they think they're right in private conversations, or are they just being right publicly, and then, like, they're really unsure in private conversations?
They are always absolutely certain.
I don't think you're gonna piss them off, because if you told them this, they're like, "Yeah, of course I'm right." Like, they
Of
know
course I'm
this
right.
too.
Yeah, of course. Yeah. Everything's undervalued that I invested in, right? And that's the interesting dichotomy in this market. So you understand why the venture guys are hyping, because they're paying 50 times ARR. Like one of the, by the way, this, I just have to go, I'm not going to name names here, but one of the totally hilarious and ironic things that I see, that you see out here on X or wherever, is like a lot of these guys are hating on the SpaceX IPO. So this is a bit of an aside, but like you get a lot of these venture guys are just like, this is outrageous. It's ridiculous. It's 100 times this year's revenue and 50 times next year's revenue. It's crazy that anyone would pay this stuff. And in the meantime, like then they're literally turning off the camera, and they're turning around, they're picking up the phone, they'll be like, oh, you have like 5 million of ARR, like that's worth $1 billion.
Yeah, but it's early stage. They're nimble, they're fast, they can move, they're agile. SpaceX builds rockets. I mean,
You've
So
got
so I think
all of that.
there's just so much hyperbole in all this stuff that you kind of have to, if you've been around any of these cycles. And that's the problem, is a lot of these voices haven't lived through a cycle.
I noticed this in the market that when people are deploying lots of money, what can they do to secure their investment? They can try to shape the field to increase the probability of their investment providing a return. And so you can do things like connect your founder that you've invested in to customers and talent. But really, at the biggest level, you can shape the narrative that pushes the momentum their way. And so the narrative would be the way that we solved this problem in the past, and anyone that did it in the past, that's dead. There's going to be a new way to do this, and this is the one to figure it out, right? And so millions and millions of dollars are going into every field to shape the narrative from the old towards the new, so to secure their investment. And every individual company from the previous era has to fight back against this narrative. Um, or does it? Like, I guess that
Doesn't.
becomes the
Now
question. Like,
that
how
I
much
think
of
is
your
the yeah, I think you're hitting on the key point there, Asad, which is you don't fight it. We're
Mm,
all riding the same wave, right? So like if you think about like what we're celebrating in the kind of AI native company, it's the, wow, we went from 0 to 10 million in ARR the first year. Now, yes, that's a sketchy definition of ARR, and yes, like we don't know if it's going to renew, and like there's a lot of questions, right? So you compare that to, let's just make it a $400 million software company that's been around for a while and has new products, right? So if you're that $400 million software company, you've been around for a while, you've got some churn in your business, you got some restructuring going on, and you have some new product, and that new product goes from 0 to 10 million in ARR in a year, what happens? Everybody yawns because
Yeah.
it's a rounding error on your growth rate, right?
Yes.
And this is the mistake a lot of, I think, founders who've gone through the cycle and gotten public make, is they assume that if they extract that data out and tell the market, oh no, we have a new product and it went from 0 to 10 million of ARR in a year, that they're going to get the extra, 500 million or $1 billion that a venture investor would put on that business as a standalone. It's not
Yes.
how
Yes.
it
Yes.
works, right?
Yeah.
Like, we have a
Yeah.
different set of investors. And so what we get instead is we get, oh, you guys are, like, and again, I'm talking as like sort of the small caps, public CEO, is like, oh, you guys are full of shit. That's not real. You have salespeople, they don't. You have distribution, they don't. You have customers, they don't. Right? I'm like, well, whose case are you making?
Who's a
Right?
co- which one's a real company?
That's why you are not good. It's like, what about like, okay, so at the same time, the plan as an operator, when I look at this situation, I'm thinking, okay, you've got all of this happening around you. And then you have to look at the business and say, okay, how do I get to 20-30% growth? And there's some sort of product related thought process one has to go through. And I think a really interesting product related decision that is being made right now in companies is you have companies like Oracle, I think is a good example. If you look at Oracle in the last couple of quarters, a lot of what they have benefited from is almost a new sort of product and service that they didn't have that existed, is like a left from what they were doing before, right? Like an enterprise software company that's doing all this data center stuff now. And so it's like deviating from what your core business, your core market was, and saying, fresh piece of paper, what do we need to do today that for which there's demand that can give us the chance to have the enterprise value that we want. And then the other group of companies I look at are saying, okay, we've got this product and we've got this market. We need to be the next version of this, the age of AI version of this. So in your world, it's like search and fire, all of this. The AI version has to come from us. How do you, if that's the spectrum, how do you decide where to fall on that spectrum? And where do you guys fall on that spectrum?
If you're not growing 20 to 30%, then like, you're just not going to create value. How do you get anybody to buy into your mission inside the company if like you're growing at 1%, right? So like, Yext, 2 years ago, we had an acquisition in the middle, so you can't really compare to 1 year ago. So 2 years ago, our like enterprise cohort was shrinking at 5% a year, right? This is what created the whole like, and by the way, this is pre-AI. This is just too much growth and cleaning up the book. And I've talked about it so much publicly that and so again, that's 2 years ago, right? So you fast forward to now, and that same enterprise segment, which is 91% of our revenue, has gone from down 5% year over year to up 1% year over year. I can't tell you I'm like, crazy pumped that we're growing 1% a year, right? But what I can tell you is that there are very few businesses that have accelerated their growth rate over the last 2 years by 6% of annual growth, right? And from -5 to +1 is almost harder to do because you've taken the melting ice cube and you started growing it again. What does it take to get people to really care about what you're doing at a company, that's been through a tough time and that is largely disregarded and forgotten in the market, like Yext?
And they're listening to all these outside voices of from a VC standpoint saying like 70%, 80% growth minimum is even that's looked poorly. So you hear all of this noise for those employees are getting bombarded with a whole bunch of stuff in the market too.
It's not easy, right? But I think if you go back to sort of like the fundamentals and you disregard the sort of, we accept at face value that like to be a high quality business, you have to be growing 20 to 30% a year, right? Like Adobe, right? Salesforce, right? These companies are not growing 20 to 30% a year, right? Adobe grows 9% a year. They had $2.5 billion of revenue each year, right? So when Salesforce grows 13%, right? They're adding, billions of dollars, right? Many billions of dollars every year. The re-rate is where the ultimately the value gets created, right? So you talked about it up front, right? This is a business today, like when we look at some of these software businesses, 1x revenue, 4x EBITDA, growing EBITDA, right? Modestly growing revenue. Like to 5x that business, right? And again, I don't want to talk about my stock price, but you just think about like historically, like you can't buy a laundromat for 4x EBITDA.
My
So
wife owns a childcare center. You could probably buy a childcare center for 4x EBITDA.
yeah, 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 you probably, yeah.
So when you look at these businesses, you're 100% right. You like, and I mean, especially because a lot of these businesses are coming up on the market right now. So there's a lot of like diligence that's happening at the
Yeah.
SMB. But yeah, sorry, continue. I
Yeah.
was just making the point that
No,
like
yeah.
you're hitting home with this.
So you take 100-year history of the markets, right? And you look at where has the most value been created. It's always in the compounding, right? It's in the okay, like maybe it only grew at 5 or 10% a year organically, right? Or less, right? But it generated a lot of cash flow, which meant that it can go. You look at some of these stories, like there's the TransDigm story. Nobody's ever heard of these in tech because they don't pay attention to this because this is like, a different kind of growth. But the sort of the Liberty Media and the sort of like, old, boring Berkshire Hathaway, stuff like that, where it's basically like we build cash flow and then we grow organically and then we grow inorganically. And like it sounds as discordant as like it is in this world of like, AI and 100%, and if you're not quadruple, triple, then you're not doing anything and blah, blah, blah. Like, the reality is that there's hundreds of years or at least 100 years in this country of history that like, if you compound effectively, you will out return these super high growth stories unless those super high growth stories eventually become compounders.
That's the issue, though, isn't it? I think that that's where OpenAI and Anthropic have really changed the game in some of this and like warped people's brains on what every company really should be looking like when the reality is like no, what you just said is true. And to me, it doesn't seem like those companies, those organizations are going anywhere. Like that compounding effect is still happening with or without AI. It's just that everything up market, the public market has just because we're now talking about billions and now even trillions of dollars, it's just like it's hitting everyone.
Do you think that that compounding is much harder of a story for a technology company, at least in the near term? Because in the rest of the market, for the new entrant AI company to do well, it has to first eat the TAM that is captured by the previous era's market leader. Like that is, we talk about this new TAM of like labor is now part of the AI
Asad, can you
TAM.
explain that a little bit? Because I think it's an interesting concept, but let me explain that a little
I
bit
think
more. What do you mean by
there's
TAM eating something? Go ahead.
I think what the market is saying these days with the amount of investment that's going into AI is that the TAM of an AI company is much larger than the TAM of a software era company previously. And the way that they explain it is that it's not just the software spend that these AI companies are going to take away and eat, they're also going to eat into labor budgets. And labor has always been a much larger spend in the economy than what we spend on software. And so hence it justifies all these big investments, crazy valuations, etc. When I think of it as like, well, how does this sequence itself? I think the AI company first has to capture the software spend. That's like the low-hanging fruit, and then make its way into the labor spend. Because if you think about it from an operations perspective, the labor spend you can only eat when you actually can replace labor. And AI is not really good enough to truly replace labor, right? Like you are a really good user of Claude in your company today, AJ. Like, have you fired any engineers? That's where you use it the
No, we've
best, right?
hired engineers.
You've
We've gone the
hired more
opposite.
engineers.
Yeah.
Yeah. So it's
Yeah.
not, it hasn't done that yet. Hasn't eaten labor budget, but it's taking away software spend from here to there. And so that's the
I'm
game.
not
I
sure
think
it's even I'm not sure it's even doing that, Asset, right? So this is the part that's like, sort of
Interesting.
the inconvenient truth. So I go out of dinosaur mode where I talk about like Harry Singleton and people no one's ever heard of who are like the greatest compounders of all
Well, you
time,
brought up
right?
Sixth
Only one
Sense, which
everyone knows is Warren Buffett. They're like, oh yeah, Warren Buffett's an amazing
Warren Buffett.
compounder. Yeah, yeah. So no one
But just
knows
for
who
the
these other
record,
people are.
just as a side note, I watched Sixth Sense with my daughters. They're 13 and twins that are 10. A couple months ago, and to see the twist and see it
Oh,
happen in
yeah.
real time with them was just exquisite. It was awesome. That
So
was
good.
really, really cool because
So
everyone got
good.
that ruined before they watched it, but to see like my daughter and one of my oldest figured it out well before it happened. So thank you for bringing that up, and that was a good throwback. That was an A+1.
I do think that the market's thinking about this a little bit wrong, right? So it's basically like, okay, well, first the AI companies have to kill the software companies, and then they can go kill all the consulting companies,
Yeah.
right? All the systems integrators. Like rough math, like, you sort of go back and look at like software is a half a trillion a year, and like, sort of services related to software and is 1.6 trillion, right? So
Yeah.
that whole pie is too, before AI, like before you start factoring, the sort of all the changes in, right? Here's what's happening, and this is the inconvenient truth of the SaaS apocalypse, is that actually there's very little evidence right now that the software pie is being eaten in any meaningful way
This
by the
is
AI native
true,
companies,
actually.
right?
This
Like,
is very true. Even
yeah,
in your churn data, it's true because, like, if you look at like 90-ish% of your revenue is above $50,000 a year in spend, you
yeah,
have almost no churn there. Like, you're completely fine in that segment of the market. So it's not like the
yep.
companies that are the AI era companies that are growing quickly are taking any of that market share. They're getting other sort of revenue.
That's not a linear thing, right? We don't go into to so if I'm an AI startup, right, I'm not going and saying like, okay, I like first mission one is eat all the software, mission two is go get the services, right? I'm if I'm doing a really good job, I'm showing up at the customer and I'm saying, What's the problem that we're going to solve?" I'm going
Yeah.
to bring my product and my expertise and my fluency with these technologies to bear to help solve your problem, right? And that may turn out to be a combination of software and services. It could actually turn out to be more services than software because you might be happy with the software infrastructure you're using.
Do you
In
think
any
what's
formula of that, it's going to get eaten together, not one at a
Is
time.
it just that we're all spending more money on, let's say, if technology is a basket of SaaS and AI, obviously some of these AI companies, like if you just look at OpenAI and Anthropic's revenue, like they're generating close to $100 billion of revenue between the two of them, and then you've got like the application layer that's probably doing another like 10-20 billion dollars underneath, and so there's hundred and let's say if you want to be generous, 150-ish billion dollars worth of AI spend in the market today, right? Between the foundation layer and the application layer.
Which
And
is
then you've got
10%
all
of
of
the
this.
services economy, the servicing basically sort of, I mean, that services, IT services is like 4 trillion a year, right?
Yes.
But
But
like
I guess the
trying
point
to,
is that
if you, there's a lot of ways to measure it, but if you cut back to like what helps deploy and use the software, it's probably more like 1.5 trillion, right? And so if you add up OpenAI and Anthropic and you say like just round numbers, even if it's 100 billion of like, how much of that is just, the internal IT buyer or whomever it is inside the large corporation saying, you know what I'm going to do is I'm gonna like deploy $100 million that I was going to deploy and that I was going to give to Accenture or Bain or Deloitte, and instead we're going to use it to see how much of this we can do
I guess
internally with.
that's the question. Is it that? Is it that we've taken spend from somewhere to put it somewhere else? Or if you're looking at your earnings and the earnings of all the SaaS era companies, and we're not necessarily seeing very high churn right now. And so churn is not high. And so that revenue seems somewhat stable. And then you've got this AI revenue that's happening. Is it that the companies spending, companies like mine and all the other companies in the market, like we're just spending more money than before? It's actually the story is that we have all decided to reduce our margins for a certain period of time because we want AI, but we haven't necessarily churned off the rest of the stuff. Like, is that what's
Well,
happening?
you have to add one more thing, at least one more thing to your analysis here, which is like what we're seeing lots of layoffs. We're seeing slower hiring. We're seeing less headcount, right? And so you could easily look, it's like you have to write your obligatory like we're laying off 20, we had the most profitable quarter and we're laying off 20% because like AI, right? But like I think a skeptic looks at that and says, is it really AI, or is this a choice that you're making because you overhired for 10 years
100%.
and
I think it's
and
bullshit. I have been saying this for a while because I'm like, well, one second. I go inside like the fanciest AI companies in the world, like the actual like AI native, AI era, whatever you want to call them. I'm like, okay, show me how you're using AI. And it's like, okay, like it's cool, but it's not like, whoa, what a different way of running the business fundamentally than what we used to run businesses like before. So then are you telling me like Microsoft has figured out something that like Cursor hasn't figured out and hence is firing like 50,000 people? Of course not. They just had they had extra hiring, like they're done and they're cleaning that up.
Well, so like I don't know, like, let's make it up. Hypothetical company, right? 10 billion in revenue and 6-7 billion in OpEx and like 4 billion in like compensation expense. Right? I just made that as a hypothetical company. Make it
I'm
all
really
up,
trying
right?
to figure out who this company is. So
It's not a
continue,
real
and
company,
I'll
right?
I'll
It's
nail
it's
it.
yeah. But like, let's just say you're a $10 billion company. You spend 40% of your sort of revenue is spent on human capital. If I just do a 10% across the board riff, 10% of that cost goes out. That's a $400 million savings, right? You know what we're
Yeah.
not seeing is we're not seeing companies say, "Hey, we laid off 10%, and I'm raising my earnings guide by that much money." So that money's going somewhere. What if in a lot of cases what we're doing is we're offloading previous overhiring or what I would call excessive specialization in the business,
Yeah.
and then we're experimenting with, can we replace that with AI, right? So this is a top line podcast. You guys very go to market focused audience, right? Like, what's one of the things that has caused sort of massive growth in the go to market function is this crazy specialization, right?
Yeah.
So we have vertical sellers and vertical service teams. We have solutions engineers. We have consulting teams. We have solutions engineers. We have overlays. We have
Assistant
various go to
SDRs.
market. So
I know.
so and why do
So
we have
many.
all that stuff? Like, we have all this stuff because, like, okay, well, we have to do a monthly SBR and a quarterly QBR with the customer, and I need somebody who's going to make all those decks, right? I mean, this is a stupid example, but it's a real one, right? So I need a whole department of people who are, we have thousands of customers. We need to, most of them are enterprises. So you're going to meet with them monthly, quarterly, whatever. You're going to deliver them, these presentations. We were living in a world for a decade or more where, like, those presentations were created by human beings and they were customized for the customer, and we were pulling from different data sets and extracting it out and putting it into slides and doing all this stuff, right? You know how long that takes today?
A minute
If,
and a
if you
half,
if you have
maybe less.
decent data and an MCP, that takes 5 minutes.
I was having this exact conversation last night with a large PE firm. They they were talking about a deal that they recently did, and they had gone inside this public software company, very legendary company, and spun something out from that. And what they found in that organization is that they had a 1-to-1 ratio between SEs and AEs, which is like pretty crazy, right? For a company that was growing less than 5% a year, it had a 1-to-1 ratio of AEs to SEs. So you had a lot of people that were just twiddling their thumbs.
I bet it had even more, an even higher ratio of CSMs to A's.
CSMs to AEs was out of whack. This is the craziest one. For a team of like, let's say, a couple of hundred sellers, like less than 200 sellers, there was about 60 people in sales ops.
Doing
Yeah,
what?
like what are we doing? What's
They were
the
all
job?
maintaining their NetSuite instance. Let me tell
I
you,
genuinely
maintaining
don't know what the
NetSuite
job
is
would be.
whew.
Like, what would you do? If you asked me, like, how many people in sales ops should there be for a company I own, like
You would
five,
say
10, like,
0. Asad
like
hates sales ops. He's railed against
I'm
revenue
just
operations
65.
for
This is
years.
untrue, AJ. This is a bad narrative for my business. Let me let me cross correct. Let me narrative correct. I love RevOps, just the best ones. I think that anything but the best is a problem with the best of it. Not for the best.
Some
So
backpedaling happening here.
people who've only known me the last 3 or 4 years are like, "Wow, you're like a real, like, private equity type cost cutting operator, right?" And I laugh because I'm like, I've never been that guy in my career, but I have kind of had to do that work the last 2 or 3 years. But because we had 12 years of easy growth and everything grew fast and everything grew big, it was like the organization could just grow. If you're growing 30%, the organization could grow 30% a year. That bred all this specialization. That's how you wind up with, well, I have 100 sellers, but I have 60 people in revenue operations, right? And they all have very specialized roles. And then you have these silos in the organization. So your RevOps team and your deal desk team and your FinOps team and your FP&A team, like, they're all separate, right? And so one of the things that we've seen, and again, I don't know why people don't talk about this more, is that when you start putting these teams together, what you realize is that all of those operating silos were incredibly inefficient. And if you are willing to allow those teams to get smaller, right, either through attrition or through just, I mean, that we're seeing a lot of rifts and layoffs and things like that, then what winds up happening is you have more resource to put into, you can be more profitable. You can buy your own stock back. You can buy other companies. You can borrow money. You have all this optionality that you didn't have when it was like the accelerators were just pressed to the floor the whole time. And my guess is that a lot of this, and by the way, I'm a huge AI bull. Like I think that this thing is real and it's going to transform things, and the economic power of it is amazing. But I think in a lot of cases you have to extract out and say, look, we are basically cutting human capital costs that were overbuilt inside the company, and that's freeing up lots of cash to experiment with these things. And the jury is still out whether the value is there or not.
We are going to come back to this question mark. This is the perfect place to take a pause, take a break, and come back in a minute. Because, AJ, do you know what time it is? Oh boy.
Is it our favorite? Is it
It's time for Quiz
Quiz
Pro
Quo? We got
Okay.
it. We nailed it.
At this point, everybody knows what we're doing. Three
boy.
questions, three options for each question. The two of you versus me.
These bags under my eyes, these are because I didn't sleep last night worrying about this.
Or you should be, because as you've seen, Michael, the guests are on the hook for getting all of these correct. We crushed it last week. We really did actually crush it last week.
AJ's been doing well without Sam
Has
here.
anyone
Yeah.
ever gotten all three right? Has anyone run
No.
the table yet?
Yes, we have. We did on your very first one. Don't lie, Asad. Asad doesn't.
I don't know.
Yeah,
I don't remember such things.
we
I
have.
don't
We went
remember.
2 for 3 last week.
Okay.
We had a
All
tough
right.
week the week before. I
I
think
have
we were 1 for 3.
Inspiration from Mark and Jason. I do not ruminate anymore, so I have no memory of bad shit. I only remember winning. I only remember.
I think it's getting harder to get all three right because Asad is just getting trickier.
Last week he was like, okay, Salesforce employees, is it 128,000? Is it 129,000? Is it 130,000? That's what Asad does. That's his trick
Okay,
in his bag.
time
Go
for the
on.
question. Question number one. We are at a point where there's growth in the US economy, which is great. I'm so glad that STA focuses on the US economy because Canada apparently is in a technical recession right now. So I'm very happy about my decision of pivoting to the US. That said, how many business applications were submitted in the US in 2025, in a year where we did have GDP growth? Question number one. Option number one, 1.5 million. Option number two, 3.5 million. AJ, option number three is 5.5 million.
Why do you call that?
These are what? These are
Business applications.
SBA, like the small business SBA application?
like-
application to start a business. I would like to start a business.
like new business. We're talking about
Yeah.
new business creation.
1.5, 3.5, 5.5 million.
1535, 5.5. He did say AJ 5.5 at the end, which I don't know if that was a red herring, but that annoyed me. Asad, don't do that again.
Yeah.
What do you think, Michael?
So we do a lot of work with location-based businesses, and there's something like 20 million location-based businesses in the US. And those businesses fail at a rate of like 20% a year. So like, if you use that as like a proxy, then just in that market, and not all businesses are location-based businesses, you'd have like 4 billion businesses going out of, or sorry, 4 million businesses going out of business. Just in, I think it's gonna be the highest number here. I think
5.5.
Extremely high number.
That is so good. I'm so impressed how you got that. It is
Yeah,
5.5.
I think he's right. 5.5. I don't think he's right because Asad also goes AJ 5.5. So that's what we're gonna
I
lock
did
in.
that to throw you guys off a little bit because I was like, I think you'll get this, but this was, I like the way you got to it.
So did we get it?
Yeah, you guys are
You got it right? Oh, amazing.
So 5.5 million businesses were started in 2025. The economy continues to grow. There's more momentum now. This Trump economy, AJ is very happy about it.
God.
And so
No, let's not go there.
this year, since the start of 2026, business applications are up compared to 2025. How up are they? 10%, 17%, or 27% compared to the same period last year?
I'd also be curious, do we think some of this, and maybe this is your third question, is AI driven, meaning layoffs? You have layoffs, so you have all these people that are like just laid off and they're like, "Ooh, I'm going to go start a business." And has overinflated the number there maybe? I don't know.
I don't know. I think there's just
I'm not asking you, Asad, for the record. You're not a
yeah.
part of this. Get out of here.
Yeah, you know, I was like, why am I taking part in
What
this?
are you doing? Quit deliberating with us.
And the first one is just psychological warfare. So because that other number was so big, my guess is it's going to be the smallest number on this one.
Ooh, my
Um,
goodness. He's playing the
but
game 4D chess. Totally
but
different here.
I also think that if you look at like just sort of GDP growth in the 4 or 5% or whatever it is that we're talking about, like you know those higher numbers would be a lot higher. So like my gut says it's what is the lower number?
10,000?
10%.
10,000?
10%, 17%,
10%.
27%.
10%.
10% growth in new business applications.
And we had last year was like a
He looks
record
too
year. So
happy.
Unfortunately, my friends, this
no, we
three in
didn't
a
lock
row is
it in.
locked
Fine.
it in. You locked it in. You locked it in. It is 17%. If I want to be accurate, it's 17.37% since
That's
the
pretty
same
high.
period of
Yeah, it's high.
yeah, it's
That
quite a
is a lot
lot.
higher.
Last question. This one is just it's not time specific, but what month of the year is known to be the month where the most business applications are registered any given year? Option number one, in the winter, dead of winter, people are sitting at home and they're like, this is fucking cold. Let me open a business. January. Option number two, summer, July, when I was born. Summer months, you're feeling good, you're a little tanned, you're like, let me start a business. Or it's time for some change. It's September. Change is in the air. Let me change my life and start a business.
It's
So
definitely not
January,
July.
July, or September,
I would
which is
say
the
either January or September, but it's got to be January, right, Mike?
It seems like almost too
depressing? I don't know.
obvious. It's like almost too obvious that it would be January, but like yeah, I mean like that's when you would do it, right?
Yeah,
Why? Why would you do it in January?
because it's your New Year's resolution. Start a
Or
business.
it's a
No,
new
people are
tax
getting
year.
fit for New Year's. They're not starting businesses. They're busy in the gym.
Okay, well then September. We're gonna go with
No, he's
September.
trying
Then.
to talk us out of the right answer here.
No, let's play reverse cycle because if he screwed us because it's not January, we're going with September, Mike. We're gonna hold strong on that.
Why would it be September?
Well, September's going into the fall. You're planning for the new year. It's the end of
Answer
Q3.
better than I do, AJ. You choose.
I think September is what we're going with.
It would obviously be my birthday month. Like it's July, guys.
July?
What? Yeah, July is a great month to start a business.
Really? That's a shocker.
Yeah.
That is a shocker.
Why?
I think it has a lot to do with people like if you look at the US, there are a lot of states that are genuinely cold. And I don't think people are in the depth of fucking seasonal depression starting a business. So I think the first thing is winter is not happening, right? So in the summer, like there's more people feeling good, like they feel happy. They've had, a couple of months of vitamin D. They've been out and about. They feel fitter. They're going to the gym more. There's more sunlight. I think those things have a huge effect. I think the summer months are also they're a little bit more relaxing because you have kids at home and not in school. And so like that daily routine is not as like stressful. So you have like a second to breathe as
All
a
right, this is
parent.
a BS. I'm calling BS on this whole thing. Here's the thing. First off, are these like applications? Like, what do you mean applications? They're filling these out to get their entity, their C corp, their S corp. What are we doing here? Also, by the time they've gotten to that point, they've started the business like months ago, like 6 months ago, like January, probably
Lost.
January.
He's objecting to the entire
We're back,
premise.
we're back to the main conversation. Mike, you wrote something that I thought was really important for everybody to read. We'll put it in the show notes. But in that, you explained this interesting thing that's playing out in the market. And I want to try to frame it and get your thoughts on what the inside baseball on this is. And so basically, we've spoken about this a little bit. You've got these AI companies that have been funded by investors and what investors can do to help their current investments that are at really high valuations. And it is record capital deployment. They want to secure the outcome. They can shape the narrative that shapes the field and pushes momentum from one direction to the other, talent, customers, all of this stuff, more capital. And so on one side, it is in their best interest to beat on mid-cap public SaaS era companies and private equity owned SaaS era companies. These are dead. This is where the future is. And then on the other side, they made a lot of investments in 2021, 2022 at these crazy valuations, and they need to try to get out of those investments. And what seems to be happening is the same companies that they're saying are going to be dead, in the back, they're coming to you and saying, hey, would you like to acquire this company of mine that I invested all this money in at this crazy valuation in 2021? Like, would you help me out? And it felt like, fuck you, please help me. And so talk to us a little bit about how this is playing out. Like, what's actually happening here? Because I don't think people are talking about this enough.
Yeah, I wrote this piece on. I wrote a little this piece called "No One's Coming to Help You," which I actually think is just something that everyone needs to understand, right? Including these hot AI founders, is like, the hot companies of just 3 or 4 years ago, like no one's coming to help them. And like, as a founder, like no one's ever coming to help you, right? Like, it's great when you're hot and everybody loves you and they want to help you. But like the second the sort of bloom is off the rose, you're on your own. And it's part of how this whole market works, right? You push the weak, birds out of the nest. The interesting thing about I think the sort of the way these companies have been funded is like, if you look at this wave of, like, call it the 2021 private software unicorns, right? And you guys talk about some of these companies on the show. I'm not going to name names, but like, it's a problem, right? These were companies that were, they were I think they were good companies. I think they were venture backed. They got some traction, and then they went into this crazy cycle in 2020, 2021, where, it was like, oh yeah, anybody could get the 10, 12, 15 times revenue deal, right? Like, that was just sort of like the minimum, right? And so they now sit with these broken capital structures, right? The money in the business is, their peers, their more profitable, larger public peers trade for 1 to 2 times ARR, right? And yet they're being held on the books of these private equity and venture firms at, you know, 7, 10, 12 times ARR. And so you have this very strange disconnect in these conversations that, like, people don't want to talk about in public, where, you're funding the company that's going to kill me. And at the same time, you're trying to sell me the private version of what I am in the public market. And you're trying to convince me that I need to pay something closer to your multiple than what the public market, which is the most efficient market, says the company would be worth if it were in the public. It's like a real, you have to sort of wrap your head around, like, signaling across the table. It's the same people, right? Like, it's not like there's not like a class of investors who did all those 21 deals and, like,
I think
aren't
it's like a new
doing the
group.
current high growth deals, right? So it's a total mind fucker, because you're basically like, yeah, like that startup I just funded that's going to kill you, like, that's worth 100 times revenue. You're at close to $500 million in revenue and wildly profitable, and you're worth 1 times revenue. And then this other company that looks a lot like you and has been around as long as you, but hasn't been as successful, and is 100 million of ARR. Well, that's got to be worth 5 or 6. And
You
you
just
just
buy
sort
it.
of sit there and you're like, what, in what universe does any of this make sense? And that's when your team makes you one of these. We go back to it, right? Like, I should have worn it, right? That's where you get one of these, because because that's because that's someone else's business model. That's not our business model.
So is that just a wait it out because we've seen this show before and we've got to let this all kind of play out because we're sitting in terms of just economics and where we're positioned in the market, we're going to wait this one out? Like, is that just the
Who?
messaging to the
Us?
team? Or yeah, I mean,
Oh no, we're
I feel-
we're 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 hammered down, right? Like, we're executing, we're building every day.
well, no, that's that you're in, of course you're innovating and building, but I guess the messaging as you see all of this, and we talked about this at the beginning of it. No, I think I'm 100% with you. First off, Align. I think this is a total clusterfuck. This is so frustrating. It's, as an operator and founder since 2021, every day I'm so frustrated. I'm frustrated at my peers that have let this happen and they went and raised at ridiculous things. I'm frustrated at the venture market. I'm frustrated at PE that is now part of this. I'm just frustrated at everyone that we've all allowed this to happen, and like there's no turning back. So I guess maybe, and I don't say this to my team because we're so heads down and focused on what we're doing. It sounds like you're saying the same thing. You're like, look, these are the things. we're okay. You all still have jobs. This is what we're doing. This is what we're working on and headed towards. And like at the end of the day, I can't. We can't. I can only control what I can control, and I can't worry about those others. I'm guessing that's the similar messaging that you're saying.
Yeah, I mean, we're paying people more. We're you know we're telling people, look, like we are a highly profitable company. We're increasing wages. We're increasing salaries. A lot of what I'm doing that's different, and we don't have to get into this whole discussion, is I'm increasingly paying people cash, and then we're talking a lot internally about, listen, like, I don't make your I think one of the things that's broken, this is a sidebar, about like the way we think about equity, privately and publicly, is like we make the investment decision for the employee. And I think in a lot of cases, like, there's another way to do this, which is you pay the employee more cash, and especially as a public company, and the employee, who knows their situation way better than I can ever know their situation, if they think Yext is a great stock to invest in, and they believe what I say about there's a many multiples opportunity here, then they can make that choice. And it's not because I arbitrarily decided that 20% of their comp is going to be in stock. But back, AJ, I think back to your other point, like, the question that when we talk about this, generally, in more private settings, people always say, well, when does it change? Like, when do those investors and there's two things that change this. One is the public market re-rates, which you started to see a little bit of, right? And it's like, okay, we go back to some degree of normalcy where, I don't trade for, where Yext doesn't trade for 1x revenue and 4x EBITDA anymore. And then, that means that theoretically I can use my currency to acquire things at higher, at higher multiples, which are more in line with my multiple. I think there's a different dynamic that people maybe don't understand as well, which is, you kind of got to raise your next fund before you dump all the junk in your last fund, right? So everybody knows and everyone's aware that these 2020, 2019, 2020, 2021 funds are not going to be good performers for the venture and private equity, because they paid too much for companies. And so, that business is interesting, because as long as you've got your next fund raised, you're in business, right? So I can, this is the extend and pretend, or whatever you want to call it. Like, as long as I can hold those marks in a way where my performance doesn't tank in the 19, 20, 21 fund long enough to raise the next fund, then I'm in business, right? And I think that's when we'll see that a lot of those, and maybe we're starting to see it. You saw Salesforce bought a company yesterday that, for less than half of what it raised at. So it's starting to happen. Although I still think that was like I don't know. It was reported to be like a 5 or 6 times ARR multiple. So somebody did a good job selling that one.
So 100% agree with it. And you have your earlier point, like, even then the VCs won't say they're wrong, because they just like kind of like just mark down or write that off. Like writing the word write off is just so easy to do. Oh, we just wrote that off. And so they'll point to the next fund that they raised as like, well, this is really where we're
Yeah,
headed. So it
I
makes it
got
a
all
lot
these
easier.
hot AI native companies in the next fund.
Yeah, who cares about 2021?
Yeah,
That's in the past.
yeah, those ones that didn't work, we paid 10 times ARR, but like these ones over here, we paid 50 times ARR. They're going to work really well.
I guess the part of it that I find the most interesting is that you have to, for these narratives to work, there has to be a this sort of binary thing, right? Like good versus bad, old versus new. And so when you take a stance on such a binary, in such a binary way, then you still have to somehow, but you still need the other sides to help you in some other way. And that you need to be able to thread that needle as well. So if you're a world-class investor, you do need to be able to convince some of the companies that in the public you're saying, they're not going to survive. You do have to convince them to buy some of your stuff. And I think it's just like it's fascinating, some of the things we all have to do and some of the needles we all have to thread to be successful. That's a tough needle for them to thread, right? Like, because if you are the operator on the other side of that, you're like, yeah, I read your blog yesterday that said like, I'm going to be dead and now you need me to pay you 300 million to buy this thing. Like, I'm very excited to do that, right?
Yeah. Yeah. And look, I mean, I think they understand the situation, right? Everyone understands the situation. And that's going to be a tough, I really feel for the entrepreneurs who are running those companies. Like, I don't know if I had been in their shoes, if I would have been able to resist here's 200 million of growth capital at, a crazy price. And you could take some of it and give it to yourself. Like, I actually have a lot of sympathy for teams who built and are running those businesses, because they're in a very tough spot today where the preference stack is worth a multiple of what like any rational buyer would pay for the company. And there's a way out, right? But it's self-help. It's a lot like what we've been doing. Everyone thought this was crazy to do this in the public market. What I've done in the last, my team and I have done the last 4 years, and I think in some ways over the last 4 years, there's plenty of times when I told you everyone was right. This is a crazy thing to do in the public market. But like, if you can get profitable and you can do the right thing by your customers and you can grow, then like you have a path, right? It might take longer than you think, and you might feel like you're missing some boat that's leaving the dock right now on the AI side of things. But I don't know how to fix that.
What do you think is like necessary for it to trade where you want it to trade? So in a way, I'm asking you, like, what's the big master plan? Like, in terms of, you don't think every company has to trade at like 30% growth, but obviously for a company like Yext, you can't trade at like the growth of a Salesforce. Like, you have to be somewhere in between that and profitable. And so what do you think that number is at which the multiples move up because the market rates it differently? And then how do you think one gets there? Like, when you're sitting with other people in your position, do you acquire yourself towards that direction, or do you build the future? I'm sure a little bit of both, but which one does the heavy lifting is, I think, the main point there. Yeah, thoughts on that?
It's all of the above, right? And I think, look, we tend to, again, you said it before, like the market needs clean narratives, right? So the market needs these narratives that say, look, Google's the, sort of generational company of the last generation, and Meta is maybe the generational company of that, slightly later of the next generation or whatever it is. And what no one talks about is the really great acquisitions that those companies did along the way. So like, how big of a piece of, YouTube looked like a crazy acquisition at 1.6 billion. And I think the acquired guys did a whole deep dive on this. Like
6 hours,
Yeah.
6 hours worth of deep dive.
a lot. That's a long drive to get through that one. But it's like you look at Meta and you're like, okay, but like, Instagram and they bought WhatsApp, right? Like it's kind of like, you have these.
And at that time, that was a crazy, crazy deal. I remember the founder of WhatsApp coming out and talking
Yeah.
about his
Yeah.
walks with Mark and like how that was what they were
Yeah.
going to do. And even Instagram was looked at as kind of a crazy deal.
We acquired a company called Hearsay, which is an amazing fit for our business and has been awesome, right? It's just been a great acquisition. And so, during those following 4 years, our company grew 12%, 14%, 16%, like that. You lap it and then it falls off because it's inorganic growth, right? But like the reality is that because that business wasn't growing a lot when we bought it. So the funny thing about this is you have to channel the, like, I'm not going to. I may hear all of the sort of the dissonance that's in the market, but I'm going to stick to what I know is true, right? So if you say, again, using the numbers that are out there, sort of, in a trailing 12-month EBITDA of 112 or 115 million dollars or whatever it is for our company, right? Like, what I do is I look at this environment, I look at how much progress we're making, I look at the way the markets, and I believe that we're about to enter a major bull cycle when it comes to how technology is purchased and deployed, and I think we're going to be a winner in that. I'm not pitching our stock here. I'm just pitching, like, I feel that we're entering an expansionary wave here. And so, like, in that, like, where I go is I've been doing this for almost 30 years. We've had a lot of success. We've built a lot of growth companies. And part of me just says, look, it's as simple as this. Do I think that in 5 years I can double the cash flow of this business or more? Right? Like, it sounds crazy, right? It's like, okay, we're going to go from 100 and something to 200 and something. And there comes a point where smart investors just say, there's a saying, like, you get the investors you deserve. Like, I write these long letters nobody reads every quarter about our business and what's happening with the business. I tell people exactly what we're going to do. We've bought 35% of the shares ever issued, right? And I know I said I'm not pitching our stock, and I'm really not. I'm telling you how, as an operator, like, we put all the noise aside and we basically say, listen, if in 5 years my company has twice as much profit, and let's just make it up and say 10% or 20% or 30% fewer shares, right? Am I worth 10% more than I am today? No, right? Like, that's a That's a 300, 400, 500% return before you kind of re-rate your multiple. And so it takes an extraordinary amount of strategic patience to just put the blinders on. You put the blinders onto the noise, but not to the market, and understand where's our advantage and how are we going to go about doing that organically, inorganically, through smart, capital allocation. And look, in 5 years, I'll either be embarrassed by this clip, and they'll be like, "Ha! Look at the guy thought he was going to double his business in 5 years," right? Which doesn't sound that crazy to anybody who's built a high growth business before. Or I'll be a little bit insufferable at some point because
Quite
We'll
right.
definitely have you on
either
at that
way, you
point.
should have me on. Like,
Well,
I'll take my
well, 2
lumps.
years ago, you were talking about all this structuring stuff and going through all this craziness, and here we
Yeah.
are 2 years, so
I
we'll
wanna
have you on. But speaking of bulls, Asad, I
Yes.
think
Bulls versus Bears.
I actually the bulls versus bears question. I want to relate it to what you just said, Mike, because something we haven't touched on is you were about to take the company private. You tried to take the company private within the last 12 months, I think, at $9 a share. So you obviously have a point of view on like you feel bullish about all of this, and you really were putting your chips on the table with that. How bullish or bearish are you about the future of mid-cap publicly traded companies, or to be publicly traded for a mid-cap software company? That setup, how do you feel about that? Is that the right way to be for a mid-cap company now?
I'm bullish on great businesses, right? I think, and when it comes to software oriented AI, non AI, however you want, legacy, new, however you want to think about it, like, I have weird ideas for a guy who's been a tech guy for 25 years. Like, one of those ideas is that businesses should be, rule of 40 or better over the long run, one way or the other. So if you don't have growth, you better be super profitable. And if you have the more growth you have, the less profit the market will let you have. But I don't think we can know what that cocktail looks like because the environment changes so much. And so you have to, I think we have to be really pragmatic about, like, my instinct right now is that we've done a ton of sort of structural work in the business, and that an easier growth environment is coming. That's my instinct, right? But, like, it's incredibly dangerous to double or triple down into an instinct like that and be wrong, right? It's much more dangerous to be ahead of that curve than it is to be a month or a quarter behind that curve. And I get a lot of criticism for this because they tell me I'm not aggressive enough. And maybe that's just because I'm like, I've done this for so many years, and like, maybe you lose some aggression. But I think what we may lose in aggression, we make up for in sort of fundamental value creation. For great businesses, I'm incredibly bullish because I think we've just endured the hardest sort of a very strange down cycle where actually the economy has been strong and the markets are at an all-time high, and we've existed in this subset of the market that really has had basically a 4-year recession. And that has to change at some point.
I love that. That's a very interesting perspective, and I tend to agree with it as well. AJ, as we wrap this up, I have a question for you. We're in the process of rolling out Anthropic centrally. If you asked me like a year or two ago, I would have said that would be a place that OpenAI would own in our business at least. And so the question I have for you is, how bullish or bearish are you about the stickiness of whichever central AI platform we pick? Like, do you think you are an Anthropic shop? Do you think once you pick something like that, it's a sticky decision the way Salesforce is a sticky decision? Or do you think this central AI platform is not as sticky as like a system of record in CRM?
I'm pretty bearish on it being sticky right now. I think similarly, we were in OpenAI and we moved to Anthropic, and the move to Anthropic was quite easy. It's a bunch of markdown files. And so this idea that you can just kind of portable, it's almost like Kubernetes, a little bit of a throwback of moving cloud providers. It's not even as hard as moving cloud providers, even though it's the entire organization.
And they do keep going up and down these models, right? Like OpenAI for a little
Well,
bit.
but that's a little bit different because you were constantly doing evals for our own product and which product, but Claude is the better product right now for organizations.
I don't know. Like a lot of people were saying Codex had gotten better than.
Yeah, Codex, sure, but I mean as an integrated spot where you have Cowork, Claude Code, and Chat all in one spot. But that can easily change, and I think to your point, where ChatGPT has done a great job in having this bridge gap to Codex, and OpenAI has gotten rid of some of their products. They got rid of, what was it called? So not Sonar. What was the
Yeah, the Sora,
the Sora? Yeah, they're
Sora,
getting rid of
the
Sora.
image
So
one.
they
Yep.
understand, like, it's really a great sign that they've realized and recognized. And I think the other thing that we just don't understand as consumers is the GPU race and OpenAI and Anthropic. Like OpenAI is winning, I believe, that race right now.
Like the prices are better, the usage limits
And
are better.
Anthropic's had some real downtime issues over the last 6 months as they've scaled up. So, I'm pretty bullish on being able to the switching costs are now, the challenge with that is it kind of goes against what, we talk about with software companies where I'm bearish on companies making switching costs to, like, Salesforce or CRM. I'm still very bearish on that, but bullish on making switching at the highest order of AI and LLMs
And
models.
when you just AJ, when you say you're bearish on switching CRM, you mean you're bearish that everyone's gonna switch, or you're bearish
Yeah,
on
I don't believe anyone's gonna be switching, CRM or,
yeah.
really truthfully, like, software like a Yext or just in
Very
general,
difficult.
distribution and data and moats, and, like, they've created a high level of trust and credibility with your customer
Yeah.
base. It blows my
We're just
mind to
not
the
seeing.
point
Yeah,
you
we're
made
just
at the
not
beginning.
seeing. Yeah, we're just not seeing that. That's where it's happening. By the way, like for what it's worth, you didn't ask me, but I totally agree. I'm going to say it anyway. The switching is unbelievable. Like I was in a meeting with our chief data officer last week, and he's like, "Hey," he was like 5 minutes late for the meeting, and he's like, "Hey, sorry, like I had to rebuild this demo real quick in Codex because our Anthropic, we were switching our plans or something, and the Anthropic system was down." And I was
Yeah.
like, "How long did that take?" He's like, "Oh, just 10 minutes." He's like, "I just had to switch,
The
put the
Thank you for
artifact
that
in there and
example.
have it do the same
Perfect.
updates." And I was like, "Okay."
Well, that's so interesting. Like, because we're smaller businesses, like for you guys, for it to be that easy as well is just crazy. It's like crazy how some, which basically means like, what's the moat? The moat has to just be like, forever I will have the better underlying model and some like workflow on top of it. But really, it's about the model. Like, if somebody's model is like 50% better, you'll just switch to it.
This feels like a big question, right? It's that question of like, if all of this capex and all of this massive capital investment is going into not a Google search winner take all, sort of like highly differentiated product, but like ultimately a commoditized marketplace, that can be really, really good for the use of AI and for all of us who use it every day. It does like it puts a little question in my mind about like, is this a like Google cash flow type business that we're seeing here or not? Maybe Apple has this all right.
That's a great question, and Mike, unfortunately, we're out of time. We have to have you on next week. Actually, what we're gonna do, we'll have you on in 3 years. We'll look at your
I hope it doesn't
predictions.
take that long. I hope that
You'll
I either
channel
look like an idiot in a year or I look really
No,
smart.
you're gonna channel your really good friends from VC and say you were 100% right and just nailed it. So,
Either way,
you're
I
right
was right.
either way. You can't lose. This might be our longest episode of Top Line we've ever had, which is I
Whoa.
mean, there's so
Sorry,
much
guys.
great stuff here. Michael, thank you so much for joining.
Thanks for having me. Great chat with you guys.
Thanks for joining us on this episode of Top Line.